My name is Jenya, for short. Great pleasure to be here, especially after lunch, and more importantly, after Juhudi Kilimo, which is one of the pilots we helped launch a few years back. So it's fantastic to see them here and continuing to grow the program. So I'll jump right into the presentation. I represent a company called Activera, and what we do is basically specialize in building different businesses, business models, as well as structuring finance for the Nexus space. And finance involves anything from grants to impact investing into commercial capital. A lot of the projects I'll talk to you and mechanisms I'll talk to you about, we've implemented with Windrock International. It's quite a sizable international NGO. They have presence, global footprint, as well as quite a deep sector expertise in each one of the sectors of energy, water, and agriculture. So what is it that we actually do? The first two bullet points refer to supply side, and basically how we work with the supply side is with the technologies themselves. We identify the technology, we assess the right fit for the technology with the location, with the farmer. We also set up demo sites and monitor the technology of the farmer. The difference with our team is that we are an independent third party, not privy to one of the suppliers. And the next two bullet points really relate to demand aggregation in terms of aggregating, looking across the value chain and figuring out the aggregation mechanisms. And I'll talk a little bit more about it during the presentation in more detail. And finally, we've heard a lot from this morning, access to finance being a critical bottleneck in the space, and that's what we do is basically devise, launch, and implement different financing mechanisms that are aimed at scaling these technologies in the emerging markets. In particular, I'll talk about three mechanisms that we have implemented or in the process of implementing. The first one is MFI, sort of table banking model. The second one is the aggregation, different mechanism that we have worked with. And the final one is leasing. And I will focus specifically on East Africa, although we've done some work in Asia. And in terms of technologies, I'll talk specifically about solar water pumping, although we've done chilling and others. So what I want to do in the next 5 minutes that I think I have left is really take you on a kind of a financing journey of how we went from Model 1 to Model 2 to Model 3, because there's really quite a pathway that we took to get there and lessons we learned along the way. So we started with this in about 2012 initially, but 2012, 2013. And what we really wanted to do is invest a lot of time in understanding the ecosystem that we were operating in. First and foremost, our main client, that is the farmer or the beneficiary. What is it that they grow? How do they bank? What can they afford? And what you see here is just an example of some of the surveys we've done through this work. Secondly, in understanding the market conditions for finance, who is lending into the agriculture, what type of clients they lend into, what type of loans, requirements. And as we sat down with many institutions, probably by now it's close to 50, we introduced the idea of solar irrigation technology to them and try to understand how do they see this beast called solar water pumping. Finally, as I mentioned previously, we are doing a lot of supply side work as well, and so by that point we had some farmers, lead farmers, who've taken up the technology. So we were basically monitoring their use and looking, what you see here is return on investment study, looking to understand how is it that the technology is transforming their farming economics, looking at the cash flows, how are they repaid, and how long does it take to repay them. So through this kind of three-way matching, we found a couple of things. One is that we needed to go around the collateral issue. That's pretty clear. We had not much down payment firepower in implementing with our farmers. And then finally, we had to stay at a tenor below 2 years and a ticket size below $500 to kind of launch this first pilot. So from this matching, we've developed a pipeline that you see here of different financing mechanisms that we are implementing or have implemented or in the process of implementation. With that, let me jump to the first model, which is the kind of more plain vanilla, if I could put it that way, MFI Table Banking model. Here, this is kind of the Jehudi Kilimo model, where the MFI is taking the lead on market activation and demonstrating the technology together with the distributor. We've gone around the collateral issue through the guarantee structure, the farmer and lending groups, and also Jehudi takes soft loans as a collateral, such as cows, which was easier to implement for, again, a very new technology in the country. The other model we had where the distributor was actually taking on that lead role of market activation, doing the demos, working with the farmers, and then bringing the different MFIs behind them. And so this is when it was in implementing this is when the rubber hit the road, and we've put the 3 matchings that I've talked about in practice. Learned a lot. First, how complex it is to put the financing, the geography, the technology, glue it together with some sort of incentives between the different parties. And obviously made mistakes. We've documented the mistakes we've made. We have a blog together with Jehudi Kilimo that's both on Aggregator, Winrock, and Jehudi's website that you can go more into on lessons we've learned through this process. Having said that, we've also emerged stronger and better than before. And for the Winrock Aggregator team, what we've learned is that this product is clearly financially viable. So we can take it to scale, but we also needed to cheapen the cost of technical assistance. And so through that, we came to the next model, which is the Aggregator Model. And here on the right-hand side, you see the more traditional SACCO co-op structure. In Kenya, it could be Cusco and Co-op Bank, who are the wholesalers onto a network of SACCOs and cooperatives, and then who then on-lend it to the farmers. On the right-hand side, on the left-hand side, we looked at we looked across the supply chain and looked at different aggregators that we could work with, starting from ag dealers to domestic wholesale buyers to processors like fruit factories, and then on to the exporters as well. And what we found is that they're very interested in this technology because for them it means security of supply for their operations. On the downside, not many wanted to take the debt onto their books. And so, meanwhile, on the wholesaler model that we're currently, that's in the process of implementation, a lot of the SACCOs are new to the technology, so on their end, they didn't want to take the asset risk. And so we've come up with a newer version of this. And basically with the leasing model, the lessor takes on a lot of the asset risk by purchasing it off of the distributor and leasing it on to the farmers. And it's also taken part of the default risk. This is where a lot of, you ask how do they offset that mechanism? And there's kind of 3 ways that we've been working on. One is the group insurance, being a large entity with a lot of equipment, it's a little bit cheaper for them. The secondly is the buyback provisions. So what we've negotiated with the manufacturer is to pay in case of a default to estimate a residual value of that equipment at different points in time, and then in which case the distributor will either sell that equipment to somebody else or sell it for scrap and then rewire the money back to the lessor. Finally, a risk guarantee fund definitely helps create more of these structures. In terms of the aggregators, we're talking about the same folks that we've seen on the previous page, and the role that they take here is looking at the kind of recommending the farmers, because they've been working with them a lot closer than the lessor or the distributor. They do a little bit of default management up front and then processing of the payments as well. Finally, on the distributor side, It frees up their working capital, and more importantly, the distributor really stays with the scheme until the duration of the lease through the service and maintenance payments that are baked into the rental payments from the lessor. So one of the final questions we were asked is the role that we've played in each one of these structures, and I've just put some bullet points to save time not to read them, but if you ask me, some of the challenging aspects of this job is this. Also getting money for technical assistance, as well as for the pilots themselves, initial loan capital and the guarantee funds. So with that, I'll take some questions.
Thank you so much, and the floor is yours for maximum 2 questions, please. So, what's the question? Everything so clear? Oh, there's one. Thank you.
Hi, Mark Montserrat from Power Progress. Just in the previous slide, could you explain a little bit more about who the lessor is, the lessor?
Yeah, so we have, the lessor is a leasing company. There's 2 of them in Kenya, and they're part of the larger financial institution setup. So there's a bank and a leasing structure within the bank.
One more? Yes, please.
Yeah, we have the 3 models. If we talk about the small, very, very small farmers,
yeah.
which model you choose?
I would probably choose the easiest to implement is probably the second one, but it's not the cheapest one. It does take quite a lot of work to aggregate the different mechanisms together, but the reach is also much broader. So.
Thank you. Thank you, Evgenia, for this interesting presentation. And the panelists, I would like to allow 3 questions, please. Yeah, please.
Thank you so much. My name is Hanson, and I came from Rwanda. I have appreciated this system because this is actually the system that can easily work and easily be adopted in my country. Although the inconvenience of low head, because my country is namely called a country of 1,000 heads. So my question is like, is there, because whatever you can actually do with the solar systems, it comes back to the pump, because this is most of the time. You can have this system with the panels that you have on the trail and it can work, but still the oceans comes to the pump. So do you have more kind of advanced prototype which can at least raise water up to 60 meters, something like, although the discharge could be a bit smaller?
Yes, and this is more a question for the whole group, because we're all talking about financing, and it looks like you measure the success of the financing and how many people are taking it up, how much water you pump, but is anybody really looking at, the water resources availability, and, is it sustainable to actually continue using all these water resources?
Third one? If not,
yes, the question from Wanda about higher head is a very important question. Unfortunately, it's a basic fact of physics that if you're pumping water, the higher the head, the more energy it's going to take, and therefore the cost of the system. It happens that with this small pump, if you want to, you can join 2 of them together in series to double the head, and or triple, or whatever you like to do, but then you'll have to spend more in upfront cost in proportion to the height that you're going to pump. So to me, the low-hanging fruit is the open water sources where there's land just beside the water. When those sites are fully exploited, then people will start going up the hills, and hopefully by then the pumps will be cheaper and more efficient. So I think we have to take it a step at a time, use them where they're use the pumps where they're most viable while working on more economical solutions for higher heads. That's my opinion. About, the question was about the sustainability. I think that's a very localized issue. In general, there is much more water available that's literally flowing away, and people aren't using it because they lack this basic means to lift the water from down there to up here. So as I think somebody said earlier, that's the role of governments to protect the environment. It should be their role. Every technology, starting with the cars that are on the road outside here, have environmental effects. I don't think we should slow down the development of this technology for that issue. I think that's a site-specific issue that the governments in those areas need to address, whether the water use might be unsustainable.
Okay, thank you for sharing this opinion and other opinion from the speakers about the question whether making financing available for solar technologies will have a negative impact on the water availability and what to do about this. Aditi.
I think that's a very good question. It keeps coming back, but again, the issue is, as John said, is very localized. The area, for instance, where we work, the Eastern Indo-Gangetic Basin, that is basically has got like up to 8-9 kilometers depth of groundwater. So you have to really, these policies, and we have a paper which has been also quoted by Hans, this report, it should be in the report, that these policies have to be region specific. Your groundwater endowments are not the same everywhere. So if you are promoting solar pumps in areas that are naturally arid and have very low recharge, then you have to be more cautious than compared to places where there is a way more recharge. Having said that, the solar pumps also have inbuilt kind of checks and balances, because it will run for only 3 to 4, 5 hours in a day without a battery. So the battery would already make it kind of not feasible financially, economically. So you have that inbuilt one which you don't have for diesel or electricity. If you get electricity for 24 hours, you can run your pumps for 24 hours. So solar pumps comes with that built-in mechanism of control, which I somehow see that people don't really realize, that inbuilt control of 5 to 6 hours. You can only use it when you have sunshine.
Thank you. Evgenia?
I would probably offer slightly a different perspective, having been more at the macro level and implementing this project across East Africa. And when I see the sheer amount of demand that's coming in for these systems, both from small-scale farmer, commercial farmer, I do get concerned about, are we reinventing another RLC scenario here? And the way we've tried to deal with it is in a couple of ways. One, through technology. There's a lot of arguments to be had that larger scale technologies are actually more economically viable and more efficient. The plus there is that they have metering systems, a lot of them. And so that at least takes care of the first part of the equation, to measure how much we actually pump out to then compare it to the water table. Secondly, we've tried to work with European Space Agency to see their data and compare it to the local data, but it's extremely difficult to get it to the very small scale. So if there's partners working on that, I'd love to talk to them about this. And finally, I think it's a question of regulation and bringing in the national government and sort of like irrigation board in Kenya to as partners from the beginning as you start scaling this project. But I personally am quite concerned about this issue for the future.
Thank you.